Good afternoon, everyone, and thanks for joining us at this Payments Association webinar in partnership with MasterCard for what I hope will be an insightful discussion on how, as an industry, we can continue to support financial inclusion by bridging the most pressing gaps. I'm Pooja Bhattu, Director of Public Policy at MasterCard, and I lead the Payment Association's Inclusion Working Group. A little bit of housekeeping before we kick off. There are captions available for this session, and if they're not showing, then there is a toggle, the control bar at the bottom of your screens. That's where you can also see the Q&A tab. And please do submit questions to today's speakers by typing your questions into that Q&A tab on the control panel. And you can send your questions in at any time during the panel discussion. You can also ask questions anonymously if you don't want your name attached. If you do have any technical issues, then please feel free to send a message through the chat box to Christina from the Payments Association. The webinar is being recorded and you will be able to access it on demand within the next 48 hours. So do look out for an email from the Payments Association on how to do that. So if you do have to drop off a bit earlier, then you can access it through the link that we sent to you. Let me kick off now by just saying a few words about why we convene this webinar. As we've all seen over the last decade, the financial services industry has evolved rapidly with new and innovative technologies and providers helping to tackle financial inclusion. Yet, recent research has shown us that millions of people are still financially underserved or financially excluded. And following the new government's commitment to a national financial inclusion strategy, we're going to discuss how financial exclusion has changed over the past 10 years, what gaps still remain, and most importantly, what should be the main priorities over the next 4 to 5 years in helping to address the most pressing barriers. The Payments Association Inclusion Working Group recently published a paper which looked at how we can unlock the opportunities across the community finance sector. And so we'll be touching on that during the discussion as well. And let me now say that I'm delighted to be joined by our panelists, Rachel McGowan, the CTO at Moneyline, Dr. Paul Vick, Senior Research Fellow at the University of Salford, and Matt Woodcock, Membership Manager at Responsible Finance. Rachel, can I start with you just to give a brief introduction, and then we'll start with the first question, if I may.
Yes, thanks, Pooja. So I'm CTO here at Moneyline. Moneyline's a not-for-profit lender with over 2 decades of community lending experience. Our mission is pretty clear and we stay very firm to it because it's very easy to drift, but our mission is very much around offering financial products and services to low-income households who are excluded from mainstream financial services and increase their financial resilience over time. Personally, a little bit more about me. I've worked for Moneyline for 3 years, but I have over 20 years experience of working in mainstream financial services. So I know how and why this part of the financial services system works. This is particularly useful when joining Moneyline. It's when we look at our products and services and ensure they fit our customer personas and always aim to achieve our mission. We recently launched a set of customer personas in our social impact report, which includes some calls to action. So I'm really keen to talk about those during the session today. So why am I here? I attended the roundtable earlier this year and most recently supported the paper that Pooja mentioned in the opening welcome speech. And I think what was really clear from that is the absolute desire to do something. The room was buzzing with desire. And we need to ride that wave of desire that we created in that room, capture it and harness it. Now, that's the tricky part of it, because if it was that easy, we certainly wouldn't be here today talking about it. So for me, it's how can we collaboratively come together to forge social impact partnerships to make a real difference. Research shows that we've got millions of people that are financially excluded. That's a lot of people and a lot of businesses, and I'm sure we can make a real difference.
Great, thank you. Dr. Paul?
Sorry, yes, hello, my name is Paul Vick. I'm a Senior Research Fellow at Salford Business School, and I've been doing research in this area for the past 15 to maybe nearly 20 years. So I'm interested in understanding the nature of financial exclusion, but especially I'm interested in what are some of the policy solutions that we can bring to bear to this issue, and which is why I'm very interested in the policy paper and some of the solutions it outlines. I also host a podcast series called Innovation in Financial Inclusion, where I'm also discussing some of these emerging issues.
Brilliant, thank you. And last but not least, Matt.
Thank you, Pooja. Hi, everybody. I'm Matt Woodcock. I'm the Membership Support Manager at Responsible Finance, and we are the UK trade body for community development finance institutions. We have around 50 members who lend to personal customers, business customers, and social enterprises, and provide access to fair and affordable credit that those individuals and businesses otherwise wouldn't have access to. The majority of people that our members support have previously been turned down by mainstream organisations, and our members are also outstanding in their ability to reach underserved communities and underserved groups. 2023 was a record year of lending for our members. So in total, across all sectors, our members lent 287 million to customers who would otherwise have been excluded. In the personal lending space, they lent 66 million to nearly 90,000 customers and saved them a total of 29 million in interest compared with high-cost lenders. That said, it remains a drop in the ocean, and our role is really to do as much as we can, working in partnership with organisations like the Payments Association to make sure that we can expand the fantastic work that the community finance sector is capable of doing.
Fantastic, and I think that's a really nice sort of segue into our first question. And with the first question, what I wanted to do was kick off the discussion by just exploring the landscape a little bit, because if we don't understand what the most pressing barriers are, then we can't really design solutions that address the needs of people that we're trying to help, essentially. So, I mean, it's been 10 years since the last major report on what financial exclusion in the UK looks like. So just a question, and Rachel, sorry, Dr. Paul, I'll start with you. How do you think financial exclusion has changed in the UK over the past decade? And therefore, what are some of the most pressing barriers that we still need to address?
Yeah, thanks. I think in some ways it feels like there's been a lot more change in the last 10 years than in the previous 10 years. In some ways, almost more in the last 5-6 years than in the previous 15 years. And I think for me, there are sort of three key sort of trends that I think are important. The first one is that a lot of the traditional forms of short-term high-cost credit, like your doorstep lenders or the home credit business sector or the rent-to-own sector, that sort of largely disappeared. Also, the payday lending sector is also reduced drastically. So a lot of the old traditional players that the community finance sector was trying to replace, that those sort of organizations are sort of gone. So there's a new landscape there. The second thing is, there's been a lot of talk about this lately, is the shift from cash both from cash and face-to-face to sort of digital forms of delivery and payment. And this has really been accelerated by COVID. And I think if you ask a lot of community finance providers, they have also closed some of their branches, partly also because there's just no footfall and people are not so interested in using that sort of mechanism. So I think that's another important aspect. And I think the final development, which is perhaps one of the more critical ones, is the cost of living crisis, which I think it's done two things. So on the one hand, it has led to an increase in destitution. So those that are really sort of at the hardcore of exclusion. But also it's meant that I think it's put a a greater proportion of people who we would normally class to be perhaps in prime or very near prime into sort of making them vulnerable and perhaps needing some of the services of community finance providers or other type of initiatives like that. And I guess just to round that off, I think so one of some of the challenges that come out of that, I think, is one is that I think some incredibly low levels of financial resilience among financially excluded consumers, probably more so than ever before in terms of little savings and also great degree of vulnerability. And I think if you look at the FCA Financial Life Survey, that sort of shows that sort of that huge degree of vulnerability there. But also, I think it's also meant that it's harder it's sort of decreased the effectiveness of traditional financial inclusion remedies. So for a lot of people, it might not be, you can't, the budget aren't sustainable, so you can't sort of provide, you can't just write off debt or provide them with debt advice, or you might not even be able to lend them money because it just isn't affordable. So I think that sort of poses some challenge for the sector, and I think also sort of it poses challenges in terms of, because for some people it's about how do we improve the markets for people, but for an increasing proportion, I guess people are sort of falling outside of the market and don't have access. I think that's a sort of poses another set of challenges for policymakers and regulators.
Yeah, so much to unpack there, Rachel. I'm going to ask you the same question and maybe just pick up some of the really excellent observations that Paul's just made.
Absolutely. So I think what we've seen here at Moneyline is building on what Dr. Paul's mentioned there, the subprime credit market for small loans, which is where we particularly focus on at Moneyline, has shrunk by 80% since 2013. Home credit has collapsed. It's probably a non-existent market at the moment, which is where a high proportion of those customers that are financially excluded at the moment would have gone and been able to have access to their revolving credit. We've seen the surge of buy now, pay later, certainly within our customer demographic, and how that is having a positive impact in some ways, but it does pose a risk due to lack of regulation and how we understand the impact of that. We're seeing pawnbroking has increased, and we're often seeing for some customers that's the last resort for them to be able to be able to access cash. And then more recently, I think from a business perspective, is reduced. The supply is reduced due to more conservative lending approaches. So the supply and the availability of small cash loans, which is what a significant percentage of this part, financially excluded customers, has reduced significantly. And how do we get them back into that cycle of being able to have some access to revolving credit? The same way as the mainstream and prime do. We all have those bumps in the road and we access credit in different ways, and how can we make sure that they've got that safety net as well? And then just picking up on a couple of other points, we see our customers do save, so they can save and they do save, but how do we build that financial resilience when it's a financial shock, that they're able to access credit to run alongside their savings, because savings are often there for a very different reason. I think we've also seen, and again, picking up Dr. Paul, really good lead in for this one for me, is the financial pressures from COVID, and they're very closely followed by the cost of living crisis. So we often see that our customers, there is a proportion where it's unaffordable, but actually they're generally financially excluded for some very different reasons as well over the last 10 years. So low or lumpy income. Not everybody receives a single one-off monthly income into their bank account, but yet a lot of our payment frequencies or payment solutions mean that we've got to pay for credit or our financial products that way. We also see low digital footprint. So we're in an age of digital lending decisions. And actually, if I'm a customer that is a cash customer, I like to use cash or payment wallets or top up prepaid cards. Not all of those credit providers also report to the credit reference agency. So how do we get real time accurate information and data to be able to make better lending decisions, and not just on historical data sets. And we've seen that definitely impact our customer base. And I think the biggest challenge, I think, even though all of that's a real challenge to look at, is how do we grow the sector to be able to offer low value credit loans? And what I mean by that is there is very little choice if a consumer wants credit for less than £400, because that is the sort of the exit out of the market that we've seen in the last 10 years. And how do we grow the sector to be able to continue to offer that when nothing else is available?
Yeah, some really excellent points. I mean, the stuff around data, I think we'll definitely pick up later on in the discussion when we talk about solutions. Matt, I wanted to bring you in as well, but just before that, I would really like us at some point to also discuss the impact of the changing labour market, the fact that we've got a lot more flexible workers now who've got flexible incomes, and they're very different to the profile of vulnerable consumers that we may have seen sort of, you know, in the 90s and in the 2000s as well. And so how can we think about financial exclusion from that perspective in a changing labour market as well, Matt?
Yeah, I mean, absolutely. Rachel and Paul have done a great job summarising, you know, huge changes over the past 10 years. I think we can all agree that financial vulnerability and exclusion has grown. There are various reports around, but by, you know, certain estimations, around a third of adults would be defined as financially vulnerable and unable to access credit. And it's, as Rachel said, it's particularly those small sum short-term loans where we've got this this perfect storm of providers having vacated the market and people with thin or no credit files struggling to access credit. And this isn't credit that would, you know, for luxury items. This is credit for lifeline items, such as the car breaking down, needing to replace a washing machine, where actually taking affordable credit is often the best option and the most affordable option. And there are lots of case studies that our members and Responsible Finance have put out there on this. So you've got that. You've also got changes in tech and digital innovation, which I know we're going to come on to that, will help us to remove some of the barriers. So you mentioned the change in the workforce, the increase in immigrant labour, and those people who struggle to provide identity. You know, we've got members who are doing innovative things with tech to support those people to access credit. But digital innovation has also created harms which are fueling, I think, this crisis. So one of the things that I wanted to highlight is the role that community finance providers play, not just in providing credit in a responsible way. You know, they can't lend to everybody, nor should they lend to everybody. But because they are not for profit and driven by social impact and doing no harm, they're also highlighting threats. One of our members, Salad, at the beginning of August, published a report into the alarming rise in online gambling, and how the mainstream sector, credit lending sector, can often inadvertently fuel that, because traditional credit bureaus' data don't detect those activities. And so that you've really got this sort of melting pot of risks, threats, challenging financial situations, which is really squeezing out, you know, a third of the population. It's absolutely huge, and it really does present a big threat to this country, to marginalise so many people and prevent them from contributing in the economy. Your point on the labour market, I think Rachel covered that. You know, again, the gig economy, flexible working, again, the systems, the infrastructure and the ecosystem that we have is predicated on a world that existed 20 years ago, where we were all paid monthly and had long-term stable jobs. We need to move, and we need to move quickly to recognise that increasing numbers of people aren't in that position, that are still able to contribute to our economy.
Yeah, really, lots of food for thought there. And I'm just going to pick up your point about contributing to the economy, and that sort of takes us into the next question that I wanted to touch on. And we know that the new government, even before they were in office and since they've been in office, growing the economy inclusively is their number one priority, and by default, therefore, for industries, financial services, but also other industries, enabling that growth and enabling people to participate in the economy productively is going to be so important. And the digital payments industry, financial services innovation, fintech innovation, the community finance sector, there is a real opportunity here for us to come together and really, going back to what Dr. Paul said about the pace of technological change being the fastest over the past 5 to 10 years than we've seen possibly, over the past 50 years. And so really to take that innovation and use it to address the barriers that we all just discussed, and so that we're not in 5 years' time still talking about a credit market that isn't working, options that don't exist for the people that need them, and also with the changing types of incomes that people have, people have different retiring patterns as well. I mean, that's a whole other webinar. But what I just wanted to ask, I think specifically, and Rachel, if I can come to you first on this one, is which digital payment services and which innovations in financial services do we think can support in addressing some of these barriers, and with a particular emphasis on the role that community finance can play? Because that was one of the reasons that we looked at community finance as part of our report with the Payments Association Inclusion Working Group, was because what we were finding was in all of these conversations, community finance wasn't really coming up as a solution, but actually there is so much potential for the sector to address many of these barriers quite effectively. And so just, your thoughts on that would be great.
Yeah, of course. I think I've got probably a wish list. So I'll go through my wish list if that's all right, in terms of what I think we could do. I think we've made some excellent progress over the last 5 to 6 years in this space. I think what probably my most challenging and most frustration I think I have is that we tend to look for innovation and digital payment service solutions for the mass. And what I mean by that is we keep leaving behind maybe that 5 or 10% that keeps growing. And actually, how can we tackle that 5 or 10% that is probably going to continue growing if we're looking at trying to address a much bigger sector of that financially excluded population? And I think the key, and I think Dr. Paul might add some elements to this as well when you go at him, but I see probably one of the biggest digital payment service innovations that if we took one and ran with it, I think that would have a real impact for our customers, offering flexible ways to pay. So moving away from traditional ways of paying. So giving the customer control back. I think we have to dispel the myth that says if we give a customer control, they won't pay. That's not true, and we're not seeing that in our VRP trial that I'll talk a little bit about in this section as well. But also allowing the customer to agree a contract with you, a payment contract, but allow them to pay it at a time when they receive their income. And that will help them manage those ups and downs throughout a period of time. And I think we almost try and design and launch processes or products that are easier to get to market and actually commercially fit. And some of these things need to be a partnership based around social impact and commerciality, and not to leave the social impact behind. So one of the things that we've been trialing for the last 6 months is variable recurring payments with our customers, and that's through a 3-year project with the Aviva Foundation. The Aviva Foundation provided us with grant funding for lending capital for us to be able to take a ring-fenced set of customers and understand if we did give you control back over your payments, if we allowed you to pay at the point where it was right and you received your income, if we allowed you to make changes right up to the point when we claim your payment or you send us your payment because something's happened that's out of control, will you continue to still pay? Will that have a positive impact on the rest of your financial bills and managing financially? We've got some really early insights from that. So, 93% said they found it easier to make payments by doing that. They sent their payment when they received their income. We've got 67% of those that are part of that project that worry less about their money. And we've got 6% more customers made their first payment on their loan with us, and 10% less customers went into arrears. So there's a few spells, I think, to dismiss that. A few myths to dispel there, that we think that by giving control back to the consumer, they won't actually maintain or manage their finances. By doing that, we give them control to look at not just their product and services with us, but it has a much wider social and health well-being impact as well. That's probably the one for me. I think we've got very stagnated around our payment solutions that just fit our tech and infrastructure, and not necessarily lived experience as part of the core design.
Yeah, perfect. Yeah, Matt, can I bring you in and then I'll go to Dr. Paul?
Yeah, I just wanted to touch on that point that Rachel made about, always focusing on the mass market. And I think that's really important when we think about innovation, because, why are providers vacating this space that community finance providers occupy and can't meet demand for, by the way? So one of the things I wanted to mention was there was an LEK report in 2023 which estimated, and I think is the best estimation I've seen, but if others have seen better, there's around 2 billion of financially viable unmet need in the personal lending space in the UK. So the need is there, and customers are there as well. Why have mainstream lenders vacated that small sum space? Well, it's not profitable. And so where is the incentive for them to invest in innovations that support that group of customers? And to that, I'd probably say two things. One is that these customers are a pipeline of future customers for banks. So Responsible Finance represents, as I mentioned earlier, CDFIs that lend to small and medium enterprises. And 90% of or 99%, I should say, rather, of their customers that they lend to have previously been turned down by banks. 90% of them go on to fully repay their loans, which is, when you think about it, that's a huge success rate. And they are creating wealth, jobs, employment opportunity in many of the communities that the personally excluded people reside. So there's evidence there that there's that pipeline. So there is an incentive, if not for the social and the moral incentive, then there's an economic incentive for banks to support the community sector to innovate for those on the margins. Secondly, as I said earlier, that number is growing. So we have to find a way to support these people to engage with financial services.
Yeah, and I just want to pick up something Rachel said, and then Dr. Paul, I'll come to you. Sometimes it's not about the choice of the different solutions that are out there. It's actually whether they meet the needs of the consumers that we're trying to help. And I think there's something really important there about us as an industry making sure that as we're innovating, and that includes open banking, VRPs, it could be prepaid cards. At MasterCard, we do a lot of work with fintechs that use prepaid card technology, which is simple. It's been around for a long time, but it really works, particularly for those customers, Rachel, as you mentioned, that don't have an ID or don't have a credit profile for many, many different reasons. And sometimes it's not necessarily about the fact that there's all this choice. It's about whether that choice maps to the needs of the consumers as well. And so with that, Dr. Paul, are there innovations or technology? I mean, AI is everywhere, and so, you know, is there a role for AI? And again, we could talk about AI and inclusion in a separate webinar. It would take, you know, a whole hour, but, you know, are there technologies that you see from your perspective that you think actually these technologies are emerging, or they're already here, but the industry isn't making use of them as much as they could and should?
Yeah, I mean, I think a key point, I guess, is what Rachel alluded to, is really that research and development within, I guess, within the payment industry and the financial services more broadly, and product development is really focused on the super included. It's focused on you and me and us who have disposable income and need to buy several products and services. So I think that sort of is a critical thing to address. So I'm sure there will be technologies like AI and other that could potentially solve, but I think the problem is that at the moment the you know, the community finance sector doesn't necessarily have capacity to drive forward that innovation, and do need partnerships working with the payment sector and other financial services companies, really. So yeah, the challenge would definitely be, challenge I would put to the industry would definitely be, you know, how can you divert more R&D resources to actually developing products and services that are explicitly developed for people on low and variable incomes. Because I think too often there are, you know, some of the barriers that community finance providers face in terms of adopting technology is that they have to take something that's developed for a different purpose and try and sort of adjust it or piece different things together. Or there might be a company who says, oh, we've developed this product, but we need to do a little soft launch. Can we do this with your customers? Rather than doing things that are actually driven by the needs of the financially excluded. And I think if I could just add one more thing, it'd be that I think that's one of the, you know, not so much talked about benefit of having community finance providers and people like Rachel at Moneyline who are dedicating time to thinking about how do we actually address problems and challenges and demands and needs of this customer segment. I think that's a real value to that. So, but I think, yeah, the need helps. So anything from the industry that can help towards that would be, I think, would perhaps spur greater innovation that's driven by the consumer needs in this segment.
Yeah, definitely. And that sort of leads on to my next question really neatly. What a wonderful panel we've got today, just helping to segue into my questions, making my life very easy. One of the things that came up in the roundtable that Rachel mentioned that the Payments Association ran at Pay360, where we kicked off this work on community finance, was awareness and access to services. And so I just wanted to touch on that in a little bit of detail, is how, when thinking about how we want to unlock the potential of the community finance sector, Matt, you'll know, Rachel, you'll know as well very well that there are already really, really excellent solutions within the community finance sector, but there's a lack of awareness, or there's an access point. And again, as more services become digital, there's a gap that starts to be created between the people that aren't as digitally skilled, and therefore they can't access the services that might be right for them and appropriate for them. So, I mean, I'll open it up to all of you. I mean, I don't know if who wants to kick off, but, you know, how do we ensure access? How do we ensure awareness?
Happy to come in there, Pooja. I mean, I think as you rightly say, awareness is shockingly low. So, you know, what can we do about that? What practically can we do about that? Well, we at Responsible Finance think there are a couple of things, and they're things that we're calling for. So firstly, Referrals from the mainstream sector when banks can't support customers is something that we desperately need to work on in partnership on, because, as I say, there are people out there who the bank's model doesn't support, but whom can access credit, should be able to access credit, and, as I say, become future customers of banks. You know, we want that. We want customers in the community finance sector who are paying higher interest rates than they would with mainstream finance providers because of the cost for community finance providers. We want them to be able to build their financial resilience such that they can return to mainstream banks. Yeah, we don't want to keep hold of our customers. So that's the first thing. Referrals absolutely need to work in partnership there. Secondly, we're calling for credit broking exemptions to be extended. Housing association landlords are currently exempt and can signpost their customers to community finance providers where appropriate. There are so many more organisations, charities, debt support providers who could also do the same thing and help put people in touch at point of need. They're the people interfacing with many of the community finance sector's customers. Let's make that happen, because the rationale is clear, and it's very straightforward to do. So if we could do those two things, that would be a huge step in the right direction.
Interestingly, one of the recommendations in our paper, which I hope everybody has had the chance to at least skim the recommendations, if you haven't had a chance to read the whole thing, was to relax the common bond. And so, Rachel, Dr. Paul, would something like that just help hugely in people that, if we relax the common bond around geography, for example, would that enable more people to just be able to access an excellent service that could be right for them, even though they don't necessarily belong to the geographical, bond with the credit union, for example? So just wanted to get your thoughts on that and any other, solutions to improve access and awareness.
Yeah, so I guess I'm not sure whether the common bond is the main sort of barrier to that, but I guess it could be one of the barriers for the credit union sector in terms of growing. I think another issue in terms of awareness is sort of, as you move from what used to be a traditional branch model to more digital, is that finding sort of appropriate and effective customer acquisition sort of models really in an online world, I think is quite challenging, where it's quite costly to acquire customers, because you have so I think that's definitely a challenge for the community finance sector. Like, how do you pick up people outside of the digital, but actually also how do you pick up a big chunk of people who are able to be online, at least to some extent, because I think that's a really tricky one.
Yeah, I think probably just to add a few other elements from me in support of what Matt and Dr. Paul have already covered. I think absolutely understand the need for referrals, and how do we work much better as an ecosystem within the financial services market, and have a market that works for everybody, because it feels a bit broken at the moment. But I think also acknowledge, as part of that, we talk about reward versus harm, and actually, is credit the answer for all of those individuals at the moment? If we think about all other elements of support that are out there, and advice might not necessarily be the right answer either, but how do we provide the support that's at the right time with the right amount of information for customers. So for example, we have utility companies that have social tariffs, we've got grants available from local housing associations, we've got a whole host of untapped support in grants there. And how do we raise awareness of that where credit isn't the answer? So wherever that consumer falls within our ecosystem, how do we make sure that yes, there will be a path for those that where there is mainstream financial services, it just doesn't fit their risk appetite, and then the community finance sector can pick that up. But actually that would be a really harmful journey for a customer if we allowed that to happen, and then it was a decline and another decline, and actually we didn't get them the right support for their circumstances. So I think that's a really important part of mapping through that journey before we jump in and refer. I also think awareness is an interesting one, because I think we talk about financial services and we talk about subprime and prime and near prime and all of that. I think the language we choose to use is often a barrier for our consumers. They probably just say, I've got a need right now, and where can I go for the best product to fulfill that need that's at an affordable price right for me? And how do we undo maybe some of the negative language around low income households for me? So if you're a low income household, we often talk about you have debt. If you're not a low income household, we talk about you have access to credit, and how do we turn the tide on that language between debt and credit, I think is a barrier as well for raising awareness. And I think we've got, especially here at Moneyline, we are really keen to make sure that we have a digital offering, but we also have a face-to-face offering. We also have a customer care team that help customers take the first steps into that digital world if they'd like to, and help and support them in small bite-sized chunks. But it's expensive. So again, going back to our commerciality as a business, to be able to offer that holistic, more than a loan wraparound service needs more than just, we need to understand how we achieve that without making sure that we maintain who's already left in the sector, but then how do we grow that, because it needs to be attractive to be able to come in and continue to offer the services that we offer at the moment. And it probably doesn't look attractive at the moment because it's really hard to make the numbers fit.
Yeah, excellent insight there as well. Now we've got about 3-4 minutes left, and then I'd like to move into the Q&A so we can get some of the audience that are listening in sort of involved in the discussion as well. Now, I'm a policy person, so the discussion wouldn't be complete if I didn't bring in the policy angle. We all know that the government has committed to a national financial inclusion strategy. They're already doing a lot of work behind the scenes to try and understand, well, what are the most pressing barriers, and therefore what should be some of the priorities that they then set out in this strategy. And so with that in mind, we're just going to sort of go around the house quickly and say sort of what are the top 2 things we think that the National Financial Inclusion Strategy should consider when it comes to sort of, the community finance mutual sector, because that growing that sector was also another manifesto commitment as well. So Matt, I'll start with you.
Thanks, Pooja. So yes, I come from a policy background as well, and it's great to see the National Financial Inclusion Strategy. My two requests would be, one, funding, maintain the current funding streams that we have coming into the sector, and press ahead with further funding. There's both an economic case and a social impact case to support the work that CDFIs do. So that's the first and most important if we're to accelerate. Secondly, it goes back to awareness. And yes, Rachel's right to remind us that we need to do that in a careful way and make sure that we make that journey for customers we refer appropriate and frictionless. But awareness, and then there's a whole raft of things that policymakers can do quite easily, without new legislation, that can help us in that regard.
Lovely. Dr. Paul?
Yeah, I mean, I'd second those. I think I guess my 2 points would be funding related. So I think ultimately, if you're going to scale up the community finance sector, I've been doing some interviews with policy makers and practitioners in France and the US, where they have a more systematic framework for providing funding to their equivalent of CDFIs. And I think there are 2 things that needs to be in place. One is there needs to be some form of mechanism for providing equity to CDFI, so they can have debt bearing, so they have capacity to take on debt. And then secondly, there needs to be a sustained source of loan capital, which I think really is probably only going to really come from the financial services sector and may need to be underpinned by some form of regulatory requirement. But those would be, yeah, probably my two things.
Yeah, and they are some of the things that we touched on in the report as well, which I'll go into in the Q&A in a bit more detail. Rachel.
I think we sound like a bit of a broken record here. So sector growth funding has to be our, I think, #1 priority if it's from a sector perspective. And I think it's understanding for me, I'm probably undoing a little bit of what's happened or what I've seen or what we've seen happen over the last 4 or 5 years, is that we need to leave and allow mainstream financial services to focus on the customers that best fit their products and services, and not give this to them as a challenge to fix, because rightly so, they've got a, you know, that they'll have products and services that fit their risk appetite and the customers that they're looking to serve. We know our customers, they trust us, and I think for us it's just allowing us, releasing us to be able to support what Dr. Paul said there. Sector, you know, the sector growth funding has to happen for us to be able to fill the gap of those that are continue to grow and to be excluded. The second one for me, and it's probably one that may have not come up before, but we think it's a real barrier, and it's something that we've been working really hard on this year, is consumer understanding in our space, in small cash loans and low income household, is understanding APR. So if there's anything, APR was brought into financial services for absolutely the right reasons, but that does not work for short-term loans for anything less than 12 months. And that creates a really confusing barrier for low-income households to be able to make informed choices about where they choose to source their credit from. So that's probably a policy ask from me. I do have one for the sector, if I can sneak it in, Pooja, if that's all right. Thank you. So for the sector, I'd really like us to look at social impact partnerships. So balance that social impact, ESG policy, whatever that needs to be, alongside your commercial product offering, but don't leave the social impact part of that relationship behind, because that is what we look for as part of our community finance sector. And we often find ourselves in lots of negotiations when we partner up for products and services to be able to help deliver our services, often get stalled at the commercial part of the business, and we often find those two teams don't really talk to each other. So it'd be really helpful if they could and look at a more holistic product offering and service for us. As not-for-profits, every single penny that we can save, we can put back in to lending to more customers.
Yeah, and Rachel, I really like that one, and it was one that we discussed in the roundtable, and then it's in our report as well. And interestingly, my fellow commissioners on the Financial Inclusion Commission, we were talking about this just last week, around how there is a role here for the policymakers and the regulator in particular in helping those tie-ups between some of the larger traditional high street financial institutions and smaller, the mutual sector. Exactly as you said, even from a social impact perspective or an ESG perspective, for them internally to just think about where they could provide expertise, technology, back office, services, so that you've got that shared, you've got those efficiencies that come from sharing things like that, but also capital, again, one for us as a sector, I think for the regulator and for Treasury to sit down and just think about in a bit more detail, but a collaboration really, I think, that could result in some real positive outcomes for consumers, the consumers that, as you said, Rachel, there are consumers that have that trust and that relationship with community finance organizations or fintechs or, just smaller providers. And so how do we really harness that and take advantage of that to then serve those people better? There was a question, I know you've answered it, Matt, but I just want to sort of bring it to everybody and bring it to Rachel and Dr. Paul as well. And we touched on access to cash and the transition that we're making as a society, just a natural transition from, you know, using less cash, or some people not using much cash at all and using digital. And banking hubs, of course, are an excellent solution that is now sort of, you know, out there to try and deal with that transition from cash. But also, Dr. Paul, you mentioned the fact that there isn't a lot of high street you know, financial services available in the way that they used to be even sort of 10 years ago. And so banking hubs sort of help with that as well. And there's a question that says, do we see a way that community finance can be maybe in part of banking hubs and that wraparound support? So Matt, I know you've answered it, but I wonder if I start with you, and then Dr. Paul and Rachel, maybe you'd like to come in if you've got any thoughts on that as well.
Yeah, I mean, I think there's a huge opportunity there. I mean, I'm very enthusiastic, of course, in my role about community finance providers. You know, I'm not trying to present as the panacea and answer to everything, but we were talking about innovation earlier, and you know, despite, as Paul said, you know, capital to invest in growth and innovation is really tough in this sector. Yet I'm amazed, as somebody fairly new to the sector, how much community finance players have done. You know, they've been one of at the forefront of innovations like open banking to make better lending decisions, recurring payments, providing people with access to benefits calculators. And I guess that's because, you know, need is the mother of invention. Sorry to sound cliched, but, you know, we're working with people who have really acute needs. And so it's a great opportunity for innovation partnerships. So based on that experience, and as I said in my answer, there are already examples. I think Moneyline is one, others are happening, of CDFIs and credit unions, who are both part of the community finance sector but slightly different, working together in partnership in communities to provide the best outcome. So we could build on that in learning what else can work in banking hubs, I think.
I'm conscious of time, but Rachel, Dr. Paul, any very quick thoughts on the banking hubs piece?
Yeah, I've got some very quick thoughts. So we're already at Moneyline piloting out 2 locations this year within the last couple of months, where we are working in similar to banking hubs, but inclusion hubs. So where we're working with local housing associations, working with advice charities, talking to some of the mainstream banking institutes to say how can we create a case study that means we can take that out wider across the UK, to just offer that more holistic hub of support, advice, access to credit, you know, access to debt advice as well. So we've got two locations that we've trialed over the last 2 months, and we're keen to expand that this year and into next year as well. So yeah, it's definitely got a place. But again, if we can collaboratively come together instead of all these different parts of the sector or financial services trying to do it, you know, that collaboration piece for me is what will make the difference.
Yeah, Dr. Paul, any thoughts on that?
Yeah, I mean, I think diversity is key, and I think it's interesting that in the States, quite a few CDFIs consist of credit union and community development loan fund and various other things. So I think that's sort of the key, because I do think they serve, you know, I think credit unions are very important, but I think they tend to serve a slightly different customer segments. I think this sort of I think it's only by working together that we can sort of serve the whole market, really.
Yeah, and that quite nicely leads on to another question that's coming from the audience, and I do in 1 minute want to try and squeeze one more question in. And the question rightly says everyone's asking things of government, and we all know that the government doesn't really have any money. So, you know, we as an industry really need to take the lead here. So just a question about how we as a financial services industry, really across traditional financial services, fintech, the community finance sector, how can we collaborate without the need to sort of ask government to get us together? How can we just collaborate better and try and bring some of these solutions that we've talked about to life?
Yeah, it's a really good question. I mean, initiatives like this, Pooja, the Payments Association bringing us together, the white paper is great. You know, that's what we need more of. I think it's helpful to have a number of voices actually saying the same thing. I don't think I think government should hear the need from various sources. But certainly, keeping this working group going, working together with the key players in the sector and mainstream banks, and partnership. Actually, let's get some partnerships off the ground, which don't rely on government money. The more we can do that, the stronger evidence base we'll have for some of the things that we're saying.
Yeah, Rachel, Paul, any thoughts on how we can collaborate better?
I think for me, just to add to Matt's point there, is I think we probably need to look a little bit more inwards at each other and the strengths of different organisations, and how. So if I use that as an example, if you're looking to develop a product for a certain part of the sector, then why not involve that part of the sector that is serving that customer? So why not get the lived experience, share the data, create that whole ecosystem of saying, how can we help you to understand in your product design, your co-design stage, but actually how do we then reciprocate that? What does that social impact partnership look like? And I think if we look a little bit more insular at each other and how we can support and help each other within our business, whether that's at R&D, whether that's at implementation, whether that's at post-implementation, looking at data, customer insight, whatever that needs to be. We don't need government to do that. We just need to get around the table and have a good old conversation about how we can help each other.
Yeah, for sure. Dr. Paul, anything to add to that? And then I have to call time.
Yeah, no, just very briefly. I think, yeah, I agree with that. I think, there's no barriers. I'm sure you can pick up the phone to Rachel and talk about how you can work together on developed products. But I would say, for one thing, on the government side, is that a lot of the things that the government could do wouldn't necessarily cost a huge amount. And obviously there would be a big sort of impact in terms of how much private capital you could leverage into it. But I definitely agree on more sort of inter-industry collaboration. So
yeah, and obviously one thing that the government and the regulators can do, which costs absolutely nothing, is the convening power that they have, and just bringing everybody to the table and reiterating how much of a priority financial inclusion is for them, and just sort of corralling that momentum behind really innovating to help bridge the gap. I just want to sort of sum up very quickly some of the key themes and some of the key things we touched upon, but first of all, just wanted to thank all three of you for a really, really thoughtful, thought-provoking session, and also just to thank everybody for attending. I mean, we started off by talking about some of the trends that we've seen over the past decade that have changed the nature of financial exclusion in the UK. I mean, in particular, just the real change to the short-term credit market. I think that's one that really stands out and one that needs to be addressed. And we need to stop people turning to more sort of under the desk type of credit solutions, because you'd much rather that somebody came to a community finance organization than went to a local loan shark. And then obviously that shift from cash to digital. What does that mean for skills? What does that mean for awareness? If you can't just walk down the high street and find a provider, you have to go online, and you're not comfortable doing so, what does that mean? And then obviously we talked about solutions, everything from some of the innovation that's already happening, open banking, etc. But then also, I think the main thing is balancing that sort of social impact, Rachel, you said, and commercial. And I think that was spot on. And also not innovating for the 95%, but really innovating for that 5-10% that we have been trying to reach for so long, but also balancing, I think, people's needs with all of the choice that they've got out there. So yeah, thank you again, and thanks to everyone for attending today's session. If you've got any other questions, please contact Christina from the Payments Association. You'll receive a survey after the webinar, and we really appreciate your feedback so we can think about how we can make things better next time as well. You'll also receive a follow-up email within the next sort of 1 or 2 days with a link with the recording of today's webinar. And then again, just on behalf of the Payments Association, MasterCard, and our speakers, thank you for joining.